Misinformation is something we need to contend with as advisors and as citizens. The 2024 U.S. election was a real-life case study, even for those of us watching the proceedings from afar. Bad actors flooded the zone with relentless falsehoods. So many deeply untrue narratives were floated that it was virtually impossible to fact-check and refute what was being said. Political debate has moved from heartfelt public policy discussions to the realm of tribalism, culture wars, and alternative facts. This trend is further complicated by foreign actors like Russia, who have a stated goal of breaking down social cohesion. Critical thought on the part of ordinary citizens seems to be lacking. It seems we haven't been trained in the critical media literacy skills required to navigate this moment. But that's just politics. How else does a rise in misinformation, uncivil discourse, and sheer noise play into our daily lives? I'll begin with the economic forecasts we seem to read daily. Forecasting economic and political vagaries is a fool's errand. So the natural response for many observers is to dismiss forecasts as a thinly veiled marketing attempt full of positive spin. For much of 2024, forecasts have often involved either a soft landing for the economy or, at worst, a short and shallow recession. Halfway through 2025, most people won't even venture a forecast about anything to do with economics or geopolitics because of the unhinged unpredictability of the American president. Nonetheless, there's a manipulation of thoughts and a manipulation of markets afoot. This has gone on for a long time, but remains largely undetected due to the subtle way the industry shifts our attention. It's all tied into the financial services industry modus operandi. Keep opinions about the future upbeat to keep the money flowing. To that end, product manufacturers, distributors, and even regulators act more or less collectively to manufacture a consensus outlook that is largely seen through rose-tinted glasses. No one would invest in the short term if doing so was likely to involve a market dip, so the need to stay the course is an entrenched part of the financial services industry playbook. We have all been trained to adopt an optimistic point of view. Once investors have been seduced by a positive narrative, everything else just falls into place as a logical consequence for the financial services industry. Advisors need to recognize that phrases like soft landing, stock picker's market, and cautiously optimistic are platitudes that have been normalized by an industry that needs people to feel good so it can maximize revenues. Meanwhile, investors need to admit that they prefer investing with someone who can plausibly suggest that an 8% or 9% or even a 10% return is achievable, rather than with someone who sets more reasonable, which is to say lower, return expectations. This is why we should ask ourselves some serious questions. 1. Are we allowing ourselves to be willfully deluded by a positive narrative simply because it makes us feel good? 2. Wouldn't we be better served with an approach rooted in simple realism? Has the consensus forecast ever predicted a meaningful downturn? Predicting a solid rate of return simply feels good, and that optimism bias creates a first derivative risk that many people fail to contemplate. There are those who think that even if something bad happens, they'll somehow escape the worst of it. Textbook optimism bias. The sunny narrative has long been a part of how the industry projects a self-serving view toward the public. It's gone on for generations. The industry engages in what I call bullshift, shifting your attention to make you feel more bullish. It's a form of intentional mindset manipulation that underpins so much of the industry's communication with investors. The other topical issue these days is the principle of free speech. Industry forecasters, when pressed, almost certainly say they're merely expressing an opinion to which they're entitled. Well, that much is true. The problem, of course, is that it's hard to reliably distinguish between giving a heartfelt opinion and the corporate imperative of gathering ever more retail client assets through the promise of a better tomorrow. It would be wise to contemplate motives. In 2025, people should think carefully and critically about public discourse in general and capital markets in particular. Things are not always as they seem. There's a great deal of risk in markets right now. No one can reliably predict how things might play out, but it seems foolish to act as though everything will turn out fine. Wanting that to be true doesn't make it true.